Money, Money, Money Budget Special.
Hello and welcome to this budget special. We're here to decode what Finance Minister Arun Jaitley's tax proposals mean for your wallet and your wealth. I'm Surabhi Upadhyay, and joining me on the show is Navneet Munot, Chief Investment Officer of SBI Mutual Fund, as well as Gautam Mehra, Leader Tax at PwC India. Gentlemen, thank you so much for joining us on the show. It's great to have you on. But before I get down to the Q&A with our guests this evening, here's a quick snapshot of what Budget 2016 has in store from a personal finance standpoint. Now let's start with the good news first. And most of it is for small income taxpayers and the middle class, one could argue. Number one, the budget has hiked the rebate enjoyed by taxpayers with income less than 5 lakh rupees from 2,000 rupees to 5,000 rupees. So that's additional savings of 3,000 rupees straight away. Number two, good news if you are a non-salaried rent-paying individual. You can now look forward to higher deduction on rent. The limit has been hiked from 24,000 rupees to 60,000 rupees per annum. Number three, the budget looks to give a push to the NPS or the National Pension Scheme. 40% of the withdrawal amount has been made tax-free now. But here, let me start bringing in some of the as well. So while 40% of the NPS corpus will get tax relief, the total tax exemption you enjoyed at the time of withdrawing your EPF money no longer exists. In a bid to bring some parity between the EPF and the NPS, 60% of the corpus withdrawn from the Employee Provident Fund will also be subject to tax now. There is another important takeaway for salaried taxpayers. Employers will now have to pay tax on their contribution to an employee's EPF on a contribution amount exceeding 1.5 lakh rupees. But if you thought that it's only salary taxpayers who have reason to feel a little glum, well, here's what the budget has in store for the super rich. Income tax surcharge on all those who are earning income above 1 crore rupees has been hiked from 12% to 15%, and those who earn dividends above 10 lakh rupees a year will have to pay 10% dividend tax. Of course, there are more provisions on housing and of course on gold bonds and several other asset classes. We'll come to all of that and more over the course of the next half hour. So let me straight away get started with our guests, Navneet and Gautam. First, initial thoughts. Let me ask you a very broad question, and that's the theme of this discussion. Has Budget 2016 succeeded in putting a little more money in people's pockets so they can spend more and at the same time try to invest more? Navneet, I'll start with you.
So the overall government spending has gone up within the constraints which were there in terms of the fiscal deficit target. Obviously, there is some money in the pocket, the transfer of money from the government's account to the consumer's account. But specific in terms of tax proposals, I'm not sure whether there are incentives where they have more money which can be, which is at their disposal in terms of additional savings or the discretionary spending. There are a number of other provisions which basically augur well from the overall investment perspective and the market perspective. And if you put a foundation for a solid macroeconomic stable environment, a good economic growth, corporate earnings go up and people have the opportunity of making money in the equity and the bond market, obviously the investments will come and they will make good returns. So I think that's far more important than maybe a little bit of tax incentive here and there.
Okay, well, they surely do bring a smile to people's face, at least on, the 29th of February, 1st March, immediate fallout after the budget. But Gautam, what do you think? I mean, the whole hope was that this time around, that'll be a way of spurring the economy as well, to give people more money to spend, thereby boost growth, at least to an extent. Has that happened?
Well, I would agree with, Navneet. I don't think there have been any significant proposals to put more money in people's pockets from a tax perspective or given any additional relief. And I don't think there were any significant expectations as well around that. In fact, if you just go back a week, the expectations were more negative about what's going to happen about, capital gains on listed shares and stuff like that. None of that has fortunately come through. So there have been a few things about, you mentioned, some of them at the start of the program. There's some incentives for a first-time home buyer. Sure. There's other stuff around that for startups, etc. But nothing which says yes, I'm going to get so much more now in my pocket to spend.
So net neutral for the wallet. Should we look at it that way? At a headline level, perhaps. Okay, so let me now talk about some of the capital market provisions or the capital market announcements that came through today. Overall, the big fear, Navneet, of course, we know was that what if the definition of long terms has changed in the way long-term capital gains tax is applied? That's not happened. But at the same time, what does this budget mean for equity investment and for the thousands and millions of investors out there who've been watching this market fall, go through the floor, and are wondering what to do with equity as an asset class now?
So on a fundamental basis, one can argue about the rationale for imposing additional tax on the people who are getting dividends in their head. The corporate has paid the tax. After that, dividend distribution tax is paid, and then the money goes to the equity holder. But given that it's applicable to people who earn more than 10 lakh rupees out of dividends in a year, it's not going to impact the millions of investors that you are talking about. For them, I think in terms of overall tax provisions, nothing much has changed. In fact, there were fears, as we talked about, of the change in the long-term capital gains. But again, I'll repeat the same point that overall, if let's say the overall tax-free bonds, the number of tax-free, the amount of tax-free bonds that is going to be issued is around 31,000 crores. With the overall tax provisions, equity remains a very attractive asset class for large number of investors, and there are very little allocation as of now. After 1 year, you get a tax-free income by investing in equities. So I think that hasn't changed.
And that hasn't been touched. Gautam, would you agree with that? And also the fact that this 10% dividend tax, till now only companies are paying the dividend distribution tax. Now individuals have to, but only those who are earning dividends in excess of 10 lakh rupees a year. So is it sort of a signal to the super rich? Does this budget give out a signal? There's also the hike in surcharge that I mentioned earlier from 12% to 15%. So what's the interpretation for the so-called wealthy from this budget?
Yeah, I think that the finance minister has to collect taxes from somewhere as well. Overall, if you see, he did mention that the direct tax impact of these budget proposals is just a drop of about 1,000 crores. There is significant excess collection on the indirect tax side, but on the direct tax side, it was almost a neutral thing. I don't think this by itself would, signal something anti-rich, but yeah, there is a lot of logic in the argument that, you're looking at 3 levels of taxation, if I may say so, for that basket. The company paying the initial tax, then the company paying the dividend distribution tax, and then to top it up, the 10%. The finance minister's logic is an 18% dividend distribution tax is not, the right, because at the maximum level, you should be paying 30%, right? And therefore, it's a 10% top up to equalize that for the higher income taxpayers.
There were also some people who were arguing, saying, why not let dividend income be taxed at the hands, or with the hands of the one who's receiving the income, and counted as part of overall income of that individual. That hasn't happened. So to that extent, is this better off, because otherwise it would have been a straight 30% cut, right?
No. So the proposal to have dividend income tax directly in the hands of the recipients would have also meant abolition of the dividend distribution tax itself, right?
Yeah.
So that would have probably put more money in people's pockets, just to go back to the first question. But this is just an incremental outlay for the high net worth individuals, whether investors or promoters.
Sure. Navneet, on capital markets, quick final point, the slight increase in STT, the securities transaction tax. Of course, I know it doesn't impact the mutual fund industry as such, but is it just a one-day sentiment negative? Will it just be something that people learn to live with?
That's only on options. Of course, it impacts the liquidity because the option writers and the buyers are also providing indirectly liquidity to the overall market. But I think these things don't impact over a longer period. And as you rightly said, that from a mutual fund perspective, we are mostly into cash equities and a little bit of futures, so it doesn't affect us.
So, gentlemen, your thoughts now on the national pension scheme, because we're hearing more and more on this with every passing year. I mean, again, this year, they've not gone ahead to the EEE or the exempt treatment, which certain people were hoping for or were arguing for. But 40% of the corpus will not attract tax at the time of withdrawal. Your thoughts? Let me come to you, Gautam, first, because at the same time, they've changed the taxation in terms of withdrawing your EPF amount as well. What kind of a signal is the government sending out here?
So the NPS did enjoy some incremental tax benefits over the other investments. So I think this is a way slightly to get parity between the two. Clearly, it continues to be an attractive savings instrument. Given the tax benefits that are available at the time of the contribution, especially for the middle class and not so much for, I would say, the higher category individuals. So I think it's just a question of wanting to get some parity.
Navneet, how do you look at the NPS, given that there's such a big thrust now, and NPS, unlike EPF, has an equity component? So does the mutual fund industry have to sit up and take notice at all? I mean, if a large corpus now starts being pushed directly into the NPS, that's competing with pure vanilla mutual funds, isn't it?
So of course mutual funds have got a long-term track record in terms of delivering good returns over a very long period, have great ability in terms of the overall investment expertise, and any kind of tax benefit which promotes the retirement security for citizens at large should be applicable, should be platform neutral obviously, and I think mutual funds should enjoy a similar tax benefit if anybody is investing for a long time for his retirement or his or her retirement. I think similar benefits should be extended to mutual funds, and the industry has been asking for it for a long time.
All right, gentlemen, we'll take a quick break. We've discussed a lot about equity. We'll also look at what Budget 2016 has in store for other asset classes, housing, alternate investment funds, and of course the government's much hyped gold, sovereign gold bond scheme and the gold monetization scheme. All that after the break.
Money, money, money. Budget special.
Welcome back here with this budget special, and we are decoding what the finance minister's tax proposals mean for your wealth and your wallet. Of course, Gautam, let me come back now to areas beyond equity, because what the budget has done is that it has tweaked the definition of long term from 3 years to 2 years for unlisted entities. So, I mean, I'm wondering what this will mean for a lot of investors and maybe high net worth investors who are investing in, let's say, private equity or who are investing in alternate investment funds, etc. So, what category of funds will this target?
Yeah, just to step back, this period of 3 years was earlier 1 year. In the earlier budget, it was increased to 3 years, which was a negative, and there were a lot of representations made that you've got a disparity between the listed and unlisted, 1 year and 3 years. So the government has pulled the 3 year back to 2 years, and I think it's a positive step. The kind of investors that this would probably impact is I would think more in the high net worth category. So this probably offsets a bit of the dividend, additional dividend tax that's going to hit them in their hands. You would typically see players like alternate investment funds investing in this category and getting returns out of exits of unlisted shares, or Indian promoters who may sell their holdings in their private companies and get the benefits from that. So that's the kind of category of investors who would see a benefit out of this.
How do you describe that market right now? I mean, we've seen the pure play equity listed market obviously go through its own motions, but how do you describe this other market of unlisted securities and unlisted companies?
Yeah, so the alternate investment funds is a growing category of capital accumulators, and I think this is one change which will benefit them, because they will be in a position then to offer slightly better post-tax returns to investors. They're doing a great job in terms of funneling capital towards the unlisted sector. A mutual fund does that a great job in the listed space. But you need these kind of players to get capital in and focus in on the unlisted sector, especially since the government's also stated intent and objective is to promote startups and those who are in the if I may say unorganized space. So I think this all goes well.
And a quick last point on some of the other asset classes. We've heard some announcements with respect to REITs as well in this year's budget. Is it good enough? Will the product finally see the light of the day and get a real impetus?
Yeah, so I mentioned at the start that this budget has seen some bold moves, and I would put the REITs change as being one of the bold moves. It was introduced a year and a half back. One did not see much action. The stumbling block was a high post-tax effective rate of return to the investors, which was probably a low post-tax effective tax rate to the investors. One would expect that with the government making this bold change of exempting dividend from dividend distribution tax, both in the hands of the REITs as well as in the hands of the investors. This should, remove the tax hindrance that was coming in the way of setting this up.
So there's complete clarity now in terms of the transfer of asset to the trust, and then finally the returns that are earned by the individual investors. So there's complete clarity in terms of taxation at both levels.
Absolutely. Okay. And the reason the industry was asking for a separate, exemption was because under REITs regulations, they're required to distribute 90% of the income out mandatorily year on year, right? And therefore the imposition of the DDT was proving to be a showstopper. So I'm glad, and I must compliment the government for taking a bold move and saying, yes, we want to promote this. We want capital in the infrastructure space and the real estate space, and let's go ahead with this change.
Navneet, that gets me to actually real estate and how you will view this asset class, even from an equity standpoint. I mean, there are lots of listed companies and they've been struggling, and we know the reasons why, primarily access to low-cost capital. How do you rate some of the announcements that came in, either on REITs or, of course, the small tinkering that we've seen in terms of affordable housing? What does the budget mean for housing?
So, of course, we have to see the fine print, but REITs, I think infrastructure investment trust, even the securitization market looks like the pass-through certificates, and probably if there is a tax pass-through and then some of the issues which were hanging around regarding the issuance of PTC can revive some of these sectors. Also, I think the focus on the affordable housing, the higher tax exemption and some of those things will go a long way in reviving the interest in the real estate. One thing we need to remember is that I think the sheer amount of money which is required in this sector, and on the other side the constraints in the banking balance sheet and the real estate balance sheets, we need alternative ways of raising resources for that particular sector, and I'm sure that the government is aware of that, and that's why some of these announcements have been made.
Speaking of strained sectors, does the budget make you feel any more comfortable in terms of stocking up bank holdings in any of your mutual fund portfolios?
So, I mean, our portfolios are over the last couple of years have been full of the retail lenders who have done pretty well. Of course, there is a strain in the corporate side of the balance sheet, but I think one can argue about the recapitalization amount to 25,000 crores, but I think we have to look at from a holistic perspective, what is the other package that comes in. If this 25,000 crore is front loaded with a commitment that the government will provide more if need be after the results are out for March quarter, should be a positive. And also, if there is an overall recovery and there are sector specific, let's say metals and textiles and some of the sectors which have been under strain, if there are more sector specific measures that are taken which can take the pressure out of some of those sectors, will go a long way in improving the stress which is there in the bank's balance sheet.
There was also, speaking of mutual funds, there was also a small mention, a very tiny mention in one of the annexures which says the services provided by mutual fund agents or distributors to a mutual fund or asset management company being taxed under forward change with effect of the 1st of April 2016. Is this going to materially alter at all the distribution landscape?
If I'm right, we need to check the fine print, but I think if the distributor is sending less than 10 lakh rupees, if they have the lesser burden of service tax, I think will definitely be very good for the distributor community. But I have to read the fine print.
Okay, fair enough. So we've discussed a lot of different asset classes. I do want to very quickly touch upon gold, because there's a little bit of tax tinkering, Gautam, on the government's own flagship schemes. It was hoping to garner a lot through the gold bond scheme and the gold monetization scheme. There were a lot of critics, and it didn't really take off perhaps in the manner in which it was envisaged. Now there are certain changes in terms of capital gains tax treatment and interest exemptions, etc. Is it pretty much on the lines of what the industry had been hoping for? Do you expect these two schemes to take off in a better way?
Yeah, so both the exemption of the interest on the deposit certificates and the granting of the indexation benefits when you're selling, I think they are giving the necessary required tax benefits that are to be done. Whether investors get into this asset class or not is, I think, a slightly more commercial and investment decision. The tax irritant has probably been taken out of the way.
But I wonder, why would anyone look at this scheme over and above, let's say, in gold ETF? Let's not even talk about the benefits or the demerit or demerit of choosing gold as an asset class right now. But Navneet, what do you say? A gold ETF perhaps would offer you similar advantages, would it not?
Yeah, and with better liquidity as well.
Okay, gentlemen. So coming down to final thoughts then, in terms of what this budget really, leaves us with, what would you say? If you take a step back and, go over the headlines again, the economy being where it is, the external situation, the global market situation being what it is, does the budget instill any more confidence in the minds of the individual taxpayer, in the minds of the individual saver?
I think we are putting a very solid foundation on having a long structural macroeconomic stability. This is also paving the way for more monetary policy accommodation. So I'm expecting a rate cut maybe before the next policy. Bond yields have moved down. I think that's another asset class which can do well. And on the equity side, I think still penetration is very small, and all the measures that have been taken to ensure ensure that economy is on a sound path. If the corporate profitability improves, I think still a good amount of money can be made by investing into equities. Structurally, the another measure, the tax amnesty scheme, I think once people do that, I mean once people convert their money, I hope that some of it will go into asset classes like equities.
Tax. I mean that's a given.
Yeah, so some of that money after that is likely to find its way into asset classes like equity, where structurally they can get good returns.
Okay, Gautam, your thoughts? Does this budget instill any more confidence, I mean, having heard the speech today than perhaps prior to it?
So the number 9 is a bit auspicious as far as Indian culture is concerned. You know, Navratri, the Navagrahas that we have.
Sure.
And I think in 2 parts, he said the whole budget is based on 9 transformational pillars, one of which was tax reforms. When he went into tax reforms, he said we have 9 priority focused areas. So I like the thought process, very clear, saying this is what we want to do. The initial read of the fine print doesn't seem to be throwing out any unpleasant surprises, no significant ones. If that's the case, again, full marks that, you know, there's nothing hidden in the fine print which one doesn't like. The other good piece is, on a host of other alternate asset classes, we spoke about securitization trusts and REITs, whether it's AIFs, asset reconstruction companies. I think there's a lot of positivity in each of those areas. Yes, the dividend piece, one has to live with the good and the bad, but I would say I'm pretty fine with that.
The 9 analogy is very interesting. Let's hope the number 9 turns out to be lucky for the Indian economy and for, of course, individual savers and consumption as well. Gentlemen, thank you so much for joining us on the show today.
Thank you.
That's it on this Budget 2016 special. Thank you for being with us.
Money, money, money. Budget Special.